This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors, and welcome to 2025. This is the first podcast of the new year, and you know what that means. I'm doing my favorite annual podcast that we do to lead off the new year, and that's the classic value stocks you should be looking for 2025. I always run this screen for the very first podcast, and we take a look back at what happened last year. So I'm going to cover what is in the screen just for those of you who are new, or if you don't remember what's in it and why I like it. But this screen is on the more premium screens on Zacks.com. If you are a premium member, you can get it on the predefined screens. It's called Classic Value Stocks with Zacks number 1 and number 2 rank. Those are the two top ranks of strong buys and buys. That is what we want to be buying here when we're buying our value stocks. This screen also has a value score of A or B. Those are the highest of the value scores. And then it has a bunch of classic value fundamentals. And that's what makes the screen so good, but very difficult to actually meet all these criteria. Like, you are a true value stock if you actually show up on this screen. So what do those include? That is a PE under 20. So that's a little higher than I normally use. I usually look at 15 and under. But for this particular screen, they're using 20 because if you go much lower, it gets even more impossible to get any stocks that actually match these criteria. The PEG is under 1. That's what we always use because that indicates both value and growth. And why not get some growth along with our value? Price to sales ratio, that is also under 1. And as I always say, people like the price to sales ratio because it can't really be manipulated or, shall I say, messed around with quite as much as the earnings can be. So you either have the sale, you sold one of those widgets, or you didn't. It's kind of hard to tinker with that metric. So price to sales under 1 means, say, if it's 0.5, then we are paying 50 cents for every dollar of the sales. And that means we're getting the sales on sale. And that's what we want. We go on to get them cheaper. So we look for under 1 with the price to sales ratio. Price to book ratio on this screen is under 2. I usually use 3 to give it a little more leeway, but this is a little tighter here with the price to book under 2. And then it also looks at price to cash flow, and you want it under 20, cheaper the better there. And that's kind of important for this screen. I didn't really realize it until I was preparing for this podcast and taking a look at some of the cash positions on some of these companies that I'm going to talk about shortly. And, they may be cheap, but having a great cash flow does matter. It matters in, the strength of the company and just that you're not getting something that might be a little more value trappy. Because cheap isn't always good, right? I still want a company that's performing well. I just want to get it cheap. So price to cash flow under 20 helps me uncover some of these with good cash flows as well. Then the stock has to close at 5 or over, $5 or higher, because we really don't want $1 or $2 stocks on this screen. And then average volume, the trading volume, has to be over 100,000 for kind of the same reason we want it over $5. We don't really want these micro caps that are very lightly traded. But even still at 100,000, that's not very high. So it still gives us quite a few stocks even by that restriction. So drum roll, please. I ran the screen and this one gave us 14 stocks this year. I was surprised by that because we keep hearing about how the market is overvalued. The S&P 500 is trading over 20 times. It's too expensive. It can't keep going. So I was thinking, there might not be that many value stocks. If you remember when I ran this screen last year at the start of 2024, there were similar concerns about the market last year. And so I was concerned about, getting any stocks last year with the screen as well, because it is so narrow. But last year, it only returned 5 stocks. That was low. Normally the screen, even when we don't run it in January, just when we run it randomly, gives me at least 6 to 8 stocks. And I can't remember a time it's given me over 20. So even getting 14 is a lot actually for the screen, but 5 last year, that was a record low that we've seen since running this screen. And so last year I had to do all 5 of the stocks. I had no choice. There wasn't, I'm going to pick the ones I like out of this list. No, we just had to go for it. And I am going to review those stocks as I do always on this episode that starts the new year, because we kind of want to see what was in last year's and what happened to them. How did they turn out for the year? So let's do that first. And then I'm going to choose 5 stocks out of the 14 to talk about for this year. So last year's was kind of interesting. We didn't have any that really took off and, were up like 70 or 80% on the year. So that's too bad. And we did have a couple that did underperform the S&P 500. That should not be a surprise. So I took the year as of today, when I'm recording this podcast, of January 8th is when I'm recording it. So I just did year numbers from there. So it goes back to January 8th, 2024. And this podcast came out on January 11th of last year of 2024. And it included, I'm just going to list out the companies: Deluxe, which is ticker DLX, KT Corp, which is ticker KT, Liberty Energy, ticker LBRT, Open Lane, ticker KAR, and then Toyota Motors, ticker TM. And the best performer out of that group of 5 was Open Lane, ticker KAR. That was up 38.8%. That's the online car buying marketplace. I was surprised by Toyota, because when I saw that it was on this list, I was like, I think Toyota was up a lot last year, because I haven't really been paying that much attention to the car manufacturers other than Tesla, and Tesla only because it's in the Max 7. But then I looked it up, and Toyota was only up 2.2% over the last year, but it had been up as much as 35% by the late spring of 2024, and then sold off into the end of the year. So Toyota could be kind of interesting here, right? So that made me a little interested. Good company. The other underperformer really was Deluxe. It was only up 6.7%, and they do modern payments and data company, but it was volatile all year. Not many people are in it, and the stock kind of up and down, but up 6.7. But again, under the S&P 500, up almost 24% during that same time. Liberty Energy up 19.2%, not too bad. And then KT Corp, which is the South Korean telecom, that one was up 22%. And that's the only one out of these 5 that made this year's list, 2025. I'm not going to talk about it again. I decided to pass on it for 2025 because we already had it last year. Why repeat it? But KT Corp also on the 14 stocks for this year's classic value stocks. And it's paying that nice dividend still, dividend yielding 4.6%. So what is on this 14 stocks? We had a lot of car companies again, the auto manufacturers, but not Toyota was not on this one, and airline stocks. So a lot of them suddenly surging on there. Remember, it has to have a Zacks rank number 1 or number 2. So something good has to be going on with those earnings estimates. And that narrows it down quite a bit. There were no energy on this year's list because those ranks are not good with most of the energy companies. Even if you're not in an explorer producer, even if you're on the services side, or even like the service stations or the refiners, it's not real good on what those estimates are looking like. And there's been more cutting than raising, I'm afraid. So energy not on this list, even though the stocks remain cheap. So it does matter when you run these things, and the Zacks rank changes daily and could change again quite a bit on energy, depending on what oil and natural gas prices do as we move through the year. But right now, analysts not too bullish on what the earnings outlook looks like for the energy companies. So no energy, but airlines and auto manufacturers outside of Toyota. So let's jump in right now. I did try to give some variety on the list. I didn't want to go all in on the car companies or the airlines, but I did include one of each on this list. And then I just really wanted to get some new names that we can talk about and follow for the year. And I will check in on them again in 2026. So let's lead it off with the first one, which is an airline. Alaska Air Group, ticker A as in Adam, L as in Larry, K, ALK. Normally, I'm not a huge fan of the airlines, but Alaska does make me a little curious how they are going to perform here in 2025, because they did complete a merger with Hawaiian Airlines, and airlines I did like quite a bit. And they basically had a monopoly on Hawaii to some extent, at least flying, inner island. And then they were pretty dominant even, coming over to the coastal. But they have some big planes because they have to fly long distances off of the islands there. And that is going to be helpful for Alaska because they can deploy those big planes to more places than just Hawaii. So they are going to take advantage of the Hawaii gates that they now have and maybe expand a lot more in international travel into Europe, or not Europe, into Asia. So they can do those connecting flights over into Asia now, and they are going to be adding some of those. They can also deploy the planes, obviously, outside of just the Hawaii network now, and use them to increase their own global footprint with their other destinations. So I like that a lot. International is the place to be. Everybody's flying internationally. There's no capacity. And I think this is going to be a big game changer for Alaska this year. The stock does not pay a dividend. It is a Zacks number 1 with an A for value. PE is just 11.2. It's got a PEG of 0.7. Earnings expected to be up 34% in 2025, and that is likely due to the closing of this Hawaiian Air deal. Expected to make $586 from $437. Shares have been hot. Everyone's thinking what I'm thinking, that this deal is going to be a game changer. Shares are up 72% in the last year, but again, still really cheap here. $8 billion market cap for Alaska Air Group. So if you're looking around for one of those airlines and you don't want to go with American, United, or Delta, keep Alaska Air Group on your radar because they just added a lot of routes and planes with Hawaiian. So that's Alaska Air Group, ALK. Okay, second company is Heidrick and Struggles. Heidrick and Struggles International. I can never say some of these names right, but I think that's right. Ticker is H as in Harry, S as in Sam, II, HSII. It's staffing and employment. I was surprised to see a staffing company on here because I thought the job market was weak. Why do I want to own a staffing company? But these shares are up 60% over the last year. So they do a lot of senior talent. They are global. They have a lot of business in Asia. But again, I thought like China was weak. Why are they in China? I'm not sure. But they are global and in Asia. So I'm not sure, but something good is going on. Third quarter revenue was up 6% year over year. Market cap is just 896 million. So this is a small cap company. It is a number two. For some reason, I don't have the value score here on the style score. I forgot to write it down, but we're going to see it's got to be an A or a B because that's what we searched for. And it is an A for value. And they pay a dividend, 1.4%. I like that with a small cap company. PE of 15.2, PEG of 0.95. So that's pretty cheap on those. And then the other metrics all fit in with what we're looking for. So 2025 earnings expected to be up 8% on 3.2% growth in revenue. So $2.90 versus $2.68 for 2024. So solid growth, what you would expect out of a staffing company. You don't really expect them to be going crazy and doing like 20% necessarily, but that would be nice at these valuations, but still very attractive for this type of growth trajectory. And it's still got that peg just under 1. So there's some growth and value there. So if you're thinking outside the box and you're looking for a small cap, you might want to keep this on your watch list. It is Heidrick and Struggles, ticker HSII. All right, that's number 2. Moving on, number 3, USNA Health Sciences, ticker U, S as in Sam, N as in Nancy, A, USNA. And they call themselves the largest publicly held nutrition, personal health, and wellness company. They're headquartered in Salt Lake City, but their largest market is actually in mainland China. So I took a look at Q3 and they had $200 million in revenue in Q3. So this is a small cap company with a market cap of $673 million. China, out of the $200 million, was $102 million. So a little over 50% of the revenue was out of China. So the Chinese market does matter. US and Europe, they're combined in their data was only 40 million. So very big in China. And they said in the third quarter that the Chinese consumer sentiment remains cautious. That's where they use cautious. Net sales in China were down 4% versus 2023, but down 11% sequentially. But sales were also down in America and Europe, down 7% there. So it wasn't just like China was the only weak one, but since it's about 50% of the sales, you are really feeling it when that one is down. So sales overall were down 6% in the third quarter year over year, as I mentioned. These shares have gotten hammered over the last year, down 31%. So that's why it's cheaper than ever. They've also had falling earnings for 3 years in a row, but it's expected to turn around here in 2025, up 26.1% to $3.09 versus $2.45. PE of 11.4, PEG of 0.95 for USNA. So it's just getting in under the wire there. But on December 23rd, they announced they were acquiring HSII. I'm saying that wrong. HIYA. HSII. They are a children's vitamins, mineral, and supplement company, and that makes sense because that's basically what they are as well, vitamins, supplements. And so now they're going to do the kids side of things. This will be accreted in 2025. They paid $205 million in cash, and yes, they actually do have that cash. At the end of the third quarter, they had $365 million sitting there. They had free cash flow through the end of the third quarter of $47 million, and they're debt-free. So, and they remain so because they're paying all cash for this acquisition. So that's quite a big acquisition. It's nice to have cash and be able to do these things as a company. That's why I like this screen, because it not only gives us the cheap stocks, but those that have these businesses generating this kind of free cash flow. Another thing about HSII is that a lot of their business is subscription based. And that's kind of the bread and butter for any company, really. If you have subscribers and they're paying every month, month after month after month, it's a very steady stream of income. It's like great for these companies. And HSII apparently is largely subscription based. So that's going to really help with the numbers here. So that's probably why the analysts are more bullish here. And we're seeing that earnings growth of 26.1% expected in 2025. Did I write down what's happening with the earnings? Oh, yes, I did, obviously, because I just said that. So that's mostly it on HSII. It's Zacks number one right now. Analysts are upping their estimates, probably because of the acquisition. It's an A for value as well. Remember, the acquisition will be accretive immediately, like right in 2025. So that would make sense. The analysts have to raise their earnings estimates. But if you're looking for something in this area, the supplement area is hot, wellness is hot, then USNA Health Sciences could be for you. But keep in mind, we don't know what's going to happen with the Chinese consumer. They'll come out of it eventually, but we could have several years of just kind of muddle throughing and stagnation. And so while things aren't terrible and you are getting the stock very cheap now that it's down 31% over the last year, you can always see stocks go lower. It can always get even cheaper. But PE of 11.4 is pretty cheap, so not a bad place maybe to dollar cost average or be keeping it on your watch list in case it falls further. Always hard to market time on something that's falling like this and has been falling for several years, really. Hard to pick the bottom. But hopefully we are getting a little bit closer because the stock is cheap. So that's USNA, ticker USNA. Okay, now we are going to get to the auto manufacturer I chose out of the ones in the screen, and it's General Motors this year, ticker GM. We've talked about it many times on the podcast over the years because it's been dirt cheap for a long time. Its PE is just 4.8 with a PEG of 0.4. The stock has rallied, actually. Some of the times when I've talked about it on the podcast, it's been kind of down on its luck. But over the last year, it's up 41%. That's beating the S&P 500. So we like that, and it remains dirt cheap. So before this rally, it was really, really cheap. It is a Zacks number 2, which is a buy with an A for value. Market cap of $57.2 billion. Earnings, what's going on there? So expected to be up, but just 4% in 2025 after a 35% gain in 2024. So we're looking at $10.75 versus $10.34 in 2024. That's a nice little gain there. Revenue, however, expected to be down 1.8% to $179.2 billion. So, if someone were to ask me, you have to buy an auto company, it can't be Tesla, which one would you buy? I'm not sure I would go for General Motors, even though it's the cheaper one. I would probably still prefer Toyota, but it's probably got to be a little pricier. No, the reason Toyota didn't make this list, I just looked it up here on Zacks.com, is because it's a number 5 strong sell right here, even though it is an A for value, and the forward PE is just 9.7, and it has a PEG ratio of 0.4. So all those things are in line. I would have to check the free cash flows, price to sales ratio, and some of the other things, but its rank is really keeping it out of this list possibly for this year again. And, but I still like it. And I'm not really sure. I'd have to go see why are the analysts all lowering for this year and actually for next year as well. What do they see there? Just lower car sales. It can't be any of their models really, because the Corolla and the RAV4 remain some of the most popular cars in the world. So I'd have to dig a little bit deeper. But if I had to choose another car company to buy, it would probably be Toyota, ticker TM, instead of General Motors, GM. But they didn't make the list. So I'm going with General Motors for this year's list. And we'll see. We'll see how it does this year. But it was up quite a bit for the last year, so we will see. So that's General Motors, ticker GM. And then we're going to wrap it up with a German company. This one is the world's leading provider of products and services for people with chronic kidney failure. They make dialysis machines and run the clinics. They are Fresenius. I'm sorry, I'm butchering it. Fresenius. Let's call it that. Fresenius Medical Care. Ticker S as in Frank, M as in Mary, S as in Sam. And they were founded all the way back in 1462 in Germany as a pharmacy, Hirsch Pharmacy. And then they stayed kind of on the pharmacy side until the 1900s. And then they switched over to some of the kidney stuff. But that's incredible. This has got to be among the oldest companies I've ever talked about and that I've ever seen, because we don't get that many that can survive in some form all throughout, over 500 years, basically. So what's going on with them? Market cap of 13.3 billion. So they are a big cap. Dividend yielding 2%. So that's nice to see. Q3 revenue growth of only 2%, however, but they managed to get their margins up. Margins that quarter were at 20.7% versus 15.4% in the prior year. They increased their free cash flow by 30%, and they reduced their debt. So I like all of that. Over the last year, though, the shares are only up 8.4%. 2025 earnings expected to be up 26.3% to $1.95 versus $1.55. PE of 11.6 and a PEG of 0.7. I didn't look up, does General Motors pay a dividend? I missed that on GM. I know some do, some didn't, some restarted them after the pandemic. Let's look. They do, 0.9. Why did I miss that? Dividend of 0.9%. But back to, I can't even say it, Fresenius Medical Care. It's just tripping me up there at the beginning of that word. So this one, like I said, 1 year up just 8.4%. But if you're looking for a specialty medical type company, this one is cheap and it is global. So you have global exposure, and the dialysis, unfortunately, is going to be global as well. So they have been very innovative over the years. If you look at the timeline about the company, you'll see a lot of new development going on there. And that's what I like to see when I'm getting some of these kind of like medical products types companies. And they are one of those. So that's Fresenius Medical Care, ticker FMS. And did I say, hold on. I don't think I said for some reason I didn't write down the rank on them. What are they? Well, we know they're a 1 or a 2 as well. They are a 1 and they have an A style score for value. So they're at the top on both of those metrics as well. Okay, so that wraps up the 5 stocks I chose out of this list of 14. There were a lot of foreign companies also on the list. A lot of them have been cheap. Everyone's piling into the Mag 7 and they don't care so much about, large cap foreign stocks or a stock like KT Corp, which is that South Korean telecom, which made the list again. But there were others in addition to that one that made this year's list. But I feel like this is a good mixture of companies for this year. And it is interesting to see a couple of airline stocks on there. So they're back in favor with the right Zacks rank because those international routes are doing well with a lot of these airlines. And really, fuel costs have also come down, and that helps them a lot as well with their margins and whatnot. So this is going to be an interesting year. There are cheap stocks out there. Some of them, like Toyota, don't have the right rank right now, but the rank can change daily, as I mentioned, and likely will when we get some new earnings reports rolling in. So keep an eye on, some of these cheap stocks you like, even if they're the wrong rank, like Toyota. Keep an eye on energy. I'm mostly out of my energy stocks. In all my portfolios here at Zacks, I have sold those because I really don't trust that there could be further downside in oil prices. And that's really going to go to those earnings, and the stocks will get sold off in that scenario and get cheaper, most likely. They are cyclical, so it will come back around. But for now, I'm out of all of those in the Zacks portfolios. I still do own APA in my own personal portfolio, but I've owned it since 2001, and I'm willing to have a little longer time horizon and ride out these cycles, obviously, because I've owned it over almost 25 years now. That seems kind of crazy. But so that's the only one I own. And that says a lot because I've owned a lot of energy stocks over the last 5 years since the pandemic lows. So energy, but I'm still have it on my watch list and I'm watching it all the time. I'm also watching those small cap banks. They did rally after the November election, but now we've had quite a sell-off into 2025, but that makes them cheaper. It's just so hard with these banks because it looks like they're going to break out and we're finally going to leave behind the post Great Financial Crisis period, which dates back to 2008 now, but they just haven't been able to do it. So we're still in 15, 16, 17, 18 years of a bear market on the small cap banks. And it will change eventually, but you got to get them cheaper. So in this more recent sell-off, a lot of them look more attractive now, but I'm watching those earnings to see what happens with the Fed cutting. The NIM might not be as good with some of the banks now, so earnings might go down with some of the banks. So I'm going to wait until after this first quarter earnings season, or what will really be fourth quarter, to see what they're saying and what kind of guidance, if anything, they're giving for the full year. And it's still a little tough on the mortgage market. A lot of the smaller banks make a lot of money off of mortgages, and that has been a struggle. And the last couple of months, even though the Fed has been cutting, the mortgage rates have been going the other direction. So a lot less business on the mortgage side, even on new originations and certainly on refis. So there's a lot going on with those small banks, but I'm going to do an episode on them coming up here to start 2025 because I do feel like that's still a really cheap area that value investors could be looking around at, and you might be able to find some good yields on some of these. I'm not sure what they're yielding, but a lot of them have been paying out the dividend because they want to keep you around, right? It's been 18 years. Why should you be holding onto the banks when you can go and buy Tesla or, any of the Mag 7s? So I'm going to do a show on those coming up. So be sure to subscribe. Make sure you're getting us. We are on YouTube. You can get all of our podcasts, including ETF Spotlight. Our great ETF podcast is over there too. We're not on the main page of Zacks. We're on Zacks podcast page. It's a separate one. So subscribe there and subscribe to the main page to get the Zacks Market Edge podcast. It'll be as a video podcast over there, and you'll have to stare at me and whoever I have on as guests on the video, but you can get both of my podcasts on YouTube now, just on the two separate channels. You can get both of them on Apple as audio podcasts. We are on Spotify, we are on Amazon Music, and we're on SoundCloud for the value investor. But get us as the Market Edge as well. It's a 2-for-1 deal on SoundCloud. Just put in Zacks. I think it's under Zacks Market Edge to find it over there, and you can get us there. But be sure to get us somewhere. Let me recap the stocks again, just in case you missed them. We had Alaska Air, ticker ALK. We had Heidrick and Struggles, ticker HSII. We had USNA Medical. They are the supplement company. They're Health Sciences. USNA Health Sciences. USNA is that ticker. General Motors, ticker GM. And then we had the one I can't pronounce, which is Fresenius Medical Care, ticker F as in Frank, MS. FMS is the ticker there. And as always, I'm bringing you value stocks every week. So again, be sure to subscribe, and I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.